Hi there. We all know that Alibaba and JD.com are undervalued. As you can see, the price to earnings for Alibaba is around 10 and for JD.com is around 12. But my question is, which one is a better investment at the current price? Because as you can see, year to date, both companies did nothing. JD is down over 50% and Alibaba is down over 21%. Of course, if you look at the highest peak, then the decline is higher, over 76%. Same for JD.com. A decline over 74%. That's quite bad for investors who bought at the highest peak. But now, as the stock price is so cheap for both companies, you can have a nice return in the long term. Something like this, over 100% or even more, 200%. So the question is, which one is a better investment at the current price? If you want to find out the answer to that question, then you have to compare their business models, what they're doing, and their future plans, what opportunities they have. Of course, if you look only at their market cap, you can see that Alibaba has over 180 billion and JD over 42 billion. In this case, you may say that JD is cheaper than Alibaba. But don't rush, because if you look at their fundamentals, their business, you will see some differences. For instance, JD has over 580 million active customers in China, and Alibaba has over 1 billion only in China, plus 300 million customers outside China, their international segment. So when you compare based on their customers, you can see that Alibaba has twice more customers than JD. Let's see more. Another indicator is the revenue. If you look at the total revenue for the last quarter, for this year 2023, you can see that JD.com had over around 247 billion renminbi. This is the total revenue. And Alibaba had about 242 billion in revenue. So as you can see, the revenue is about the same. JD has a little bit more. But if you look at their segments, you can see that JD makes most of their money from product revenue, of about 197 billion, and only 52 billion from services, logistics and marketing. Now, Alibaba has more segments, as you can see. They make money from Taobao and Tmall, Alibaba International, local services, SciNow, cloud intelligence, and digital media. So they are more diversified. If you want to compare only their e-commerce segment from China, then you have to look at Taobao and Tmall. And you can see that for the last quarter, they made over about 97 billion renminbi. And JD made over 190 billion. So this is twice. So JD is making more money from e-commerce than Alibaba. Of course, this is based on the revenue. This means that Alibaba can grow more in the future. They have more opportunity to expand their business, if they can. And JD can also grow, but the growth rate won't be that high, because as you can see, year over year, the growth rate has declined a little. Now, as the total revenue is about the same, and JD makes more money from e-commerce, then why Alibaba has a market cap of around 183 billion and JD only 42 billion? Why that? Well, the answer is simple. If you look at the income from operations, you can see that Alibaba made over 43 billion renminbi in the last quarter, and JD made only 9.3 billion renminbi. So this is a big difference. 9 billion and 43 billion. So Alibaba is much more profitable than JD. Their profit margins are higher. And that's why there is this difference between their market caps. 183 billion for Alibaba and only 42 billion for JD. Of course, if JD.com improves its earnings, their profits, Maybe they'll expand their marketplace in marketing, logistics services, and they'll also may take advantage of other opportunities. Then JD can also go up in market cap a lot, from 42 billion to 183 billion. That will be a nice return if JD grows more in the future. That's why you have to look at their business, what they're doing, and assess their future opportunities. Because at the end, what matters is their profits. Which company delivers higher earnings? Now, let's continue. Another metric that can help is their cash on hand. As you can see, JD has about 42 billion in cash. And that's quite a lot because their market cap is about the same, 42 billion. So it's like you are buying JD for their cash on hand. They have $26 in cash per share. And this stock is quite undervalued at the current price. Because if JD grows more in the future, their net revenue will improve, and also their profits, maybe they'll make more money from advertising, then the stock price can go up a lot, as it happened in 2021. An increase over 200% in just 1 year. And that's amazing. So the upside for JD can be quite huge. Of course, if you subtract their debt, then the net cash will be around 46 billion. That's still nice. The stock price is still undervalued. Now, let's look at Alibaba. As you can see, their net cash position is around 62 billion. But be aware that this is only their cash. This amount doesn't include their investments. Because if you add up all their investments, their net value will be higher, over 100 billion. And as the market cap is around 183 billion, the stock price is cheap, as they have a lot of cash on hand, plus their earnings are expected to improve, to increase more in the future. As you can see in the last quarter, their income from operations has increased over 34%. And for the last 6 months, an amazing performance, a growth rate over 52%. That's amazing. And you wonder why the stock price keeps going down. Year to date, a decline over 21%, while their earnings, especially their profits from operations, went up a lot, over 52%. Well, the answer is not as simple, because the market doesn't like Alibaba at the current moment. But when the sentiment changes, the upside can be quite huge, over 100% or even more, 200%. It also depends on you, how much you want to wait for this investment to rebound. Now let's see another metric, and that is the number of shares. As you can see, JD keeps issuing more shares. Not that much, but they may issue more shares in the future. As you can see, the number of shares was about 1.4 billion at the end of 2019. And now the number of shares has increased to 1.57 billion. That's a little bit of dilution. That can decrease your return. But if they don't issue too many shares, then you can still have a nice return from this investment, from JD.com. Now, if you compare the number of shares from JD to Alibaba, you can see an improvement. The number of shares for Alibaba has decreased from 2.7 billion to 2.5 billion. And they keep doing more buybacks. They still have over around 14 billion left for buybacks. Of course, that amount may increase more in the future, as the stock price is so cheap, $72 per share, they may increase that amount for buybacks. And when a company does more buybacks, maybe you know what happens to the stock price. In the long term, it goes up a lot, because the number of shares decreases and the earnings per share go up. So this is a plus for Alibaba. Now, to answer the first question, which one is a better investment between Alibaba and JD? You saw that both are undervalued. Alibaba has a better business model than JD, but the upside for both companies can be huge, because they have more opportunities, tailwinds from China, and their profits may improve in the future. Moreover, don't forget that JD doesn't sell its products internationally, as Alibaba does. And this may be a possible future opportunity for JD. Because if you read the news, you can see that JD wants to expand internationally, to offer the supply chain services globally. Plus, they continue to invest more outside of China, as they have a lot of cash on hand, over 42 billion. They may open their own platform, as Alibaba did with AliExpress, and that can be a new source of revenue for JD. You also have to take into account that opportunity. It may happen. You never know. They have a lot of cash, and they may plan to expand international with their e-commerce segment. If that happens, and they announce their international platform, then the stock price will go up quite a lot. But of course, don't forget that what matters are their final profits. How much money they make at the end. Last quarter, the net income was about 1 billion. If they can improve their profitability, especially their margins, to increase them, then JD can go up a lot. Even more than Alibaba. But don't forget, if you compare their business models, Alibaba is much better than JD. So the upside for JD may be higher than Alibaba in the long term, but only if their profit margins improve. If they expand internationally, and they may offer other services. But currently Alibaba has a better business model. It's more diversified, their profit margins are high, they have other opportunities, especially with their cloud segment, and in the long term, also Alibaba can deliver high profits. My prediction is that both companies will do great in the future. At the current stock price, both are undervalued, and in the long term, they will deliver a great return on an investment. So it's up to you, which one you prefer. And if you have any questions, please let me know in the comments.